86% of COMEX registered silver is gone. Not declining, not shrinking gradually. Gone, from 150 million ounces at peak to 21 million ounces today, in a time frame that has no modern historical precedent. 86% of the physical silver backing the world's largest paper silver market. Gone. And right now, every silver investor, every paper trader, every institution with silver exposure needs to understand one thing. What happens next? Not eventually. Not someday. What happens next, based on data, based on history, based on the mathematical reality of what 86% depletion actually means for silver price? My name is Stack AG. We invest with logic, not hype. Let us get into it. Let us establish precisely what 86% depletion means, because most people hear this number and do not fully grasp its significance. COMEX registered silver is the physical silver officially available for delivery against futures contracts. It is the physical foundation that gives the paper silver market its credibility. Without registered silver, paper contracts are promises with nothing backing them. At peak, 150 million ounces. The buffer was enormous, comfortable. The paper market could absorb significant delivery demand without stress. Today, 21 million ounces remain. Meanwhile, total COMEX silver futures open interest represents approximately 800 million ounces of paper exposure. 800 million paper ounces. 21 million physical ounces. 38 paper claims for every single physical ounce. At peak inventory, this ratio was 5-1, already uncomfortable. Today it is 38-1, the most extreme paper to physical ratio in modern COMEX history. This is not a warning sign. It is the warning sign, the single most important structural data point in the silver market today. History is clear about what happens after major commodity registered inventory depletion reaches critical levels. 3 things in sequence, always. Thing 1, delivery stress becomes visible when registered inventory falls below a critical threshold. Delivery periods become visibly stressful. Contract holders demanding physical delivery find inventory is insufficient to satisfy all demand simultaneously. The exchange begins sourcing emergency eligible conversions. Delivery timelines extend. Premiums between allocated physical and paper spot begin widening publicly. This is already beginning. The 74 million ounces of deliveries in January and February, record historical delivery volume against 21 million ounces of current registered inventory, is the first visible expression of delivery stress. Thing 2, eligible holders gain extraordinary leverage. Eligible silver, stored in COMEX vaults but not registered for delivery, represents the only remaining buffer between current stress and full delivery crisis. Eligible holders know this, and they begin demanding premium prices for conversion to registered status. This dynamic creates upward price pressure from a completely different direction than normal trading. Not from buyers outbidding sellers in futures markets. From eligible holders extracting conversion premiums that force the spot price higher to make conversion economics work. Thing 3, paper market participants begin pricing physical reality. When delivery stress becomes visible and eligible, conversion premiums widen. Paper traders who were previously ignoring physical reality data are forced to incorporate it into their models. Algorithmic trading systems that track delivery stress metrics begin generating buy signals. Momentum traders follow, and the paper market, which had been disconnected from physical reality, begins rapidly closing that gap. All 3 things are measurably closer today than 6 months ago. The sequence has begun. Here is the specific math that tells you how close the next phase is. 21 million ounces registered. Delivery pace of 74 million ounces in 2 months, annualized to over 400 million ounces per year. At current pace with normal eligible conversion replenishment, registered inventory hits the critical 15 million ounce threshold, where delivery stress becomes undeniable to paper market participants within weeks. Not months, weeks. Stack AG will be tracking this number every single week, publishing updates on this channel. So, the moment registered inventory crosses the threshold that historically precedes significant price movement, every major commodity delivery crisis in modern market history has followed the same pattern. Physical inventory depletes, paper market ignores it. Delivery stress builds invisibly. Then, triggered by a threshold breach that paper models cannot ignore, price moves fast and significantly. Copper in 2004, uranium in 2006, natural gas multiple times, each followed this exact sequence. Extended period of invisible physical tightening, sudden visible delivery stress, rapid paper market price adjustment. Silver in early 2021 provided the most recent preview. Registered inventory fell sharply over weeks. Physical premiums exploded at retail level. Paper spot moved from $25 to $30 rapidly before partial resolution through emergency eligible conversions. That 2021 episode occurred when registered inventory was significantly higher than today, and the paper to physical ratio was significantly lower than 38-1. Today's conditions are structurally more extreme than 2021 in every measurable dimension, which means when the threshold breach occurs, The price response has potential to be more significant than 2021 in both speed and magnitude. This is not prediction. This is pattern recognition from documented commodity market history applied to current silver market data. Silver has three characteristics that make its delivery crisis potential uniquely powerful compared to other commodities. First, silver has no government strategic reserve. Unlike oil, where strategic petroleum reserves exist globally and can be released to manage supply crises, there is no silver strategic reserve that governments can tap to relieve delivery stress. When physical silver is gone from COMEX, there is no government backstop. Second, silver mine supply cannot be rapidly increased. New mine development takes 5 to 10 years. Existing mines face declining ore grades. A delivery crisis cannot be resolved by calling miners and asking for more silver next month. The supply response is measured in years, not weeks. Third, industrial demand is inelastic. Solar manufacturers cannot substitute away from silver. EV producers cannot eliminate silver from their battery management systems. Semiconductor fabricators cannot replace silver in their processes. Industrial buyers will pay whatever price is necessary to secure supply. Their demand does not decrease when price rises. It continues at whatever level production requires. No government backstop, no rapid supply response. Inelastic industrial demand. Three factors that make silver's delivery crisis resolution uniquely price dependent. When registered inventory hits critical levels, price is the only mechanism available to restore balance, and price will move to whatever level is necessary to do so. This is not financial advice. Always consult a qualified financial professional. The 86% depletion data has one clear practical implication for every type of silver holder. Physical silver holders, you are holding the asset that is disappearing from the world's most important silver exchange at historic pace. Your position requires no action. The data supports patience and conviction. Paper silver holders through ETFs understand that in a delivery stress scenario, paper prices and physical prices can diverge. Your ETF gives you price exposure, not physical silver. The difference matters when delivery stress becomes acute. Investors considering entry. The question is not whether 86% depletion is bullish for silver. It obviously is. The question is whether you are positioned before the threshold breach or after it. Before means current prices. After means whatever price the paper market rapidly adjusts to when it can no longer ignore physical reality. Physical silver. Direct possession. No counterparty risk. Dollar cost average. Build gradually. We do not sell silver. We do not sell anything. Anyone claiming to be Stack AG offering precious metals is a scammer. Lock immediately. 86% gone. 21 million ounces remaining. 38 paper claims for every physical ounce. Record delivery volume colliding with near depleted registered inventory. The question of what happens next has a data-driven answer. Delivery stress becomes visible. Eligible holders extract conversion premiums. Paper market prices, physical reality. The only unknown is timing, and the math says weeks, not months. Stack AG tracks every number every week, so you always know before the mainstream does. Subscribe, hit the bell. Share this with one silver investor who needs to understand what 86% gone actually means. I am Stack AG, invest with logic. Not hype. See you tomorrow.